71 years old, 43 years at the same bank, never one late payment. And on a Tuesday morning in March of 2026, Margaret Chen walked up to her bank's ATM in Phoenix, Arizona, typed in her PIN, the same PIN she had used for 11 years, and watched the screen display two words she had never seen before in her life. Transaction declined. She tried again. Transaction declined. She walked inside, stood at the counter, asked the teller what was happening. The teller looked at her screen, looked at Margaret, looked back at her screen, and said 6 words that changed everything. There is a hold on your account. No letter, no phone call, no warning of any kind. Margaret had $31,000 in that checking account. Money she had spent 3 years carefully saving after her husband passed. Money she needed that morning to pay her property taxes before the county deadline at 5 p.m. She did not pay them on time. She did not get an explanation that day. And she did not get her money back for 11 days. Margaret Chen did not steal anything. Margaret Chen did not owe anything. Margaret Chen did not even know that the number sitting in her checking account had placed her directly inside the targeting system of the most powerful financial surveillance infrastructure the United States government has ever quietly built against its own citizens. And right now, today, as you are watching this video, there is a very specific dollar amount sitting in your checking account that may have already done the same thing to you without you knowing it yet. I am going to tell you exactly what that number is before this video ends. But more importantly, I am going to tell you the 5 invisible tripwires that the IRS automated monitoring system uses to flag ordinary checking accounts belonging to ordinary law-abiding Americans every single day in 2026. And I am going to give you the exact step-by-step protection plan that takes less than 1 week to execute and could be the difference between financial security and the kind of Tuesday morning Margaret Chen had in Phoenix. Stay with me through every minute of this video, because what you are about to learn is something your bank will never tell you, your financial advisor has probably never mentioned, and the mainstream media has completely failed to explain in plain language to the people who need it most. Before I walk you through the 5 tripwires, I need you to understand something fundamental about why 2026 specifically is the year this matters more than it ever has before. Because I know what some of you are thinking right now. I have heard this kind of warning before. Banks freeze accounts sometimes. That is not new. You are right. It is not new. But what is happening in 2026 is categorically different from anything that came before it. And the difference comes down to one event that happened in 2022 that most Americans either forgot about or never fully understood. In 2022, Congress passed the Inflation Reduction Act. Inside that bill, buried past the headlines about drug prices and climate provisions, was an $80 billion funding boost to the IRS, the single largest infusion of resources the agency had received in its entire 80-year history. Now here is the question almost no one asked at the time. What exactly did the IRS spend that money on? Not auditors, not paper, not filing cabinets, machines, artificial intelligence systems, real-time monitoring engines, cross-referencing software that connects your bank deposit history to your tax filings, to your Social Security records, to your Medicare enrollment, to your property records. All stitched together into a single unified surveillance infrastructure that as of January 2026 watches every dollar that enters or leaves your checking account every single minute of every single business day. And here is the detail that should stop you cold. Your bank, whether it is a giant national institution or the small community bank your family has used for 40 years, is legally required to feed your transaction data into this federal system automatically. The teller does not ask your permission. The branch manager does not send you a notice. The data flows silently and continuously from your bank's servers into federal hands every single business day. This is not a rumor. This is not a theory. This is the operational reality of banking in America in 2026. And the system has 5 specific trigger patterns, 5 tripwires, that cause it to flag an account for review and potentially initiate a hold. I am going to walk you through every single one of them right now. And I want you to listen to each one not as an abstract financial concept, but as a specific scenario that may describe something that has already happened inside your own checking account in the last 12 months. Tripwire number 1, the balance to income mismatch flag. This is the tripwire that caught Margaret Chen in Phoenix. The federal monitoring system has built, for every American with a checking account and a filed tax return, a mathematical profile. A model of what your account balance should look like at any given time based on your reported income. For a retired couple receiving $2,800 combined in Social Security and $1,200 from a pension, the system expects to see a checking account balance somewhere in the range of $3,000 to $6,000. When that balance climbs to $20,000, $30,000, or higher, the system does not pause to consider context. It does not stop to account for the fact that you just sold your car, that your sister passed away and left you a small inheritance, that you received a retroactive payment from the Social Security Fairness Act that Congress passed in late 2024. It sees a number that does not match its model. It fires a flag, and within 48 to 72 hours, your bank receives a notification that can result in a hold being placed on your account while the discrepancy is reviewed. Margaret's $31,000 balance against her reported retirement income was, to the system, an unexplained anomaly. To Margaret, it was 3 years of careful saving after losing her husband. The system does not know the difference, and it does not try to find out before it acts. Tripwire number 2, the structured deposit pattern. This one has destroyed people who had absolutely no idea they were doing anything wrong. Under Title 31 of the United States Code, Section 5324, it is a federal felony to structure deposits or withdrawals for the purpose of avoiding the $10,000 mandatory bank reporting threshold. The penalty is up to 5 years in federal prison and fines up to $250,000. Here is what makes this tripwire so devastating. The government does not need to prove that you knew the $10,000 rule existed. They only need to prove that your pattern of transactions looks like it was designed to stay below it. Let me give you a real example so you understand this is not hypothetical. A 67-year-old retired teacher in rural Iowa named Donald Perkins sold his woodworking equipment over the course of several months as he prepared to move from his farmhouse into a smaller home near his daughter. He received cash payments from various buyers. He deposited that cash in amounts between $4,000 and $8,000 over a series of weeks. He was not trying to avoid any reporting threshold. He was simply depositing the money as he received it. The IRS monitoring system flagged the pattern as structured deposits. His account was frozen. Federal investigators contacted his bank. Donald spent the next 8 months and $22,000 in legal fees, proving that the deposits were from the legitimate sale of his personal property. He was never charged, but he was never made whole either. That is the structuring trap. And as of 2026, the algorithm that detects it is more sensitive than it has ever been. Tripwire number 3, the unexplained large deposit flag. Pay very close attention to this one because this is the tripwire that is catching the highest number of seniors in 2026 specifically. Here is the scenario. You receive a check in the mail. It might be a retroactive Social Security payment from the Fairness Act. It might be the proceeds from selling a vehicle. It might be a life insurance payout after losing a spouse. It might be a small inheritance from a sibling. It might be a class action settlement check that arrived completely unexpectedly. You take that check to your bank. You deposit it. You feel relieved that the money has arrived. And in that exact moment, without knowing it, you have walked directly into tripwire number 3. The federal monitoring system cross-references every deposit above a certain threshold against your most recent tax return. When a deposit appears that does not match a previously reported income source, the system fires an unexplained large deposit flag. What makes this so cruel is that virtually every deposit that triggers this flag is entirely legal money that belongs entirely to the person depositing it. The system cannot distinguish between unreported income and a completely legitimate one-time deposit from a life event. It treats both identically, it flags both the same way, and the hold that results affects both the same way. If you have received any lump sum deposit in the past 12 months that was larger than your normal monthly income pattern, there is a meaningful chance your account has already been flagged and you have not been told. Tripwire number 4, the international transfer flag. This one targets a growing number of seniors who have family living outside the United States. As of 2026, the threshold for automatic flagging of international wire transfers has dropped significantly below the historical $10,000 reporting line. Transfers to certain countries are flagged regardless of dollar amount, and the frequency of transfers matters as much as the size. A grandmother sending $1,500 a month to her elderly mother living abroad is not breaking any law. A widow sending $3,000 to help a grandchild with university tuition overseas is not engaged in any criminal activity. But the monitoring system does not pause to consider relationships or purposes. The flag fires. The data is forwarded to FinCEN, the Financial Crimes Enforcement Network. And if the senior's tax return does not include the specific disclosure forms required for foreign financial activity, forms that most seniors have never heard of and have never been told they might need, the account is queued for an extended review that can last weeks. Tripwire number 5. The cryptocurrency adjacency flag. This is the newest tripwire and the one almost no senior sees coming. As of 2026, every cryptocurrency exchange operating in the United States is required to report every transaction to the IRS, regardless of the dollar amount involved. Here is how this flag closes on seniors who have never touched cryptocurrency in their lives. Many seniors share a joint checking account with an adult child, typically a son or daughter who began helping manage finances after the death of a spouse. If that adult child uses the joint account for any cryptocurrency-related activity, even a single small transaction, the exchange reports the activity to the IRS. The system links that report to the joint account. The entire account is flagged for review. The senior may have never heard the word Bitcoin spoken aloud in their life. They may not have the faintest idea what a cryptocurrency exchange is. But their account is now under federal review because of activity conducted by someone else on an account they share. I want you to stop for just one moment right now. Not after this section. Right now. If you have your phone near you or your computer in front of you, I want you to open your banking app and look at your checking account balance. The actual number. Today's number, not last month's statement, not the rough figure you keep in the back of your mind. The real number right now. Because the next thing I am going to tell you is the single most important connection in this entire video. A connection between your checking account balance and a Medicare penalty that could permanently increase what you pay for healthcare every single month for the rest of your life. And you need to know your real balance before I explain it so that you understand exactly where you stand. Go ahead, I will be here. Here is the connection I promised you at the start of this video. When the federal system flags your account, your bank does not always freeze the entire balance immediately. Sometimes the bank places what compliance professionals call a soft hold. A hold that prevents outgoing withdrawals while still allowing incoming deposits to continue arriving normally. Your Social Security payment lands in your account on its scheduled date. You can see the money. It appears on your statement in plain black numbers, but you cannot touch it. You cannot withdraw it. And here is where the situation becomes genuinely devastating for your long-term financial health. Your Medicare Part B premium in 2026 is $185 per month for most beneficiaries. Under normal circumstances, that premium is deducted automatically from your Social Security payment before it ever reaches your bank account. You never have to think about it. It simply happens. But when your account is under a soft hold, that automatic deduction mechanism can fail. When it fails, Medicare does not absorb the missed payment on your behalf and send you a friendly notice. Medicare generates a direct billing statement and mails it to your address in a plain white envelope with no special marking, no urgency indicator, no warning label of any kind. It looks exactly like the kind of mail you set aside to deal with later. If you miss that envelope in the chaos of dealing with a frozen account and fail to pay the premium within the grace period, your Medicare Part B coverage lapses. And when you eventually re-enroll, you face a permanent late enrollment penalty of 10% added to your Part B premium for every 12 months you were without coverage. At today's premium of $185 per month, a single 12-month lapse adds $18.50 to your monthly premium permanently. 2 years adds $37 per month, permanently. That penalty does not expire when you turn a certain age. It does not get reduced after a period of good standing. It does not go away under any circumstance short of a formal appeal process that succeeds less than 20% of the time. It follows you on every single Medicare bill until the last day of your life. A frozen checking account triggered by an algorithm that misread your savings balance can permanently increase your healthcare costs for the rest of your life. That is the full chain. And it starts with the number in your checking account today. So what is the number? What is the specific dollar amount that the balance-to-income mismatch flag is calibrated to watch for among retirees receiving typical Social Security and pension income? Here it is plainly. If your monthly income from all reported sources totals between $3,000 and $5,000, which describes the majority of American retirees, the Federal Monitoring System's baseline model expects your checking account balance to stay within a range of roughly 1 to 2 months of that income at any given time. That means a balance consistently above $8,000 to $10,000 against a $4,000 monthly income begins to create a statistical anomaly in the system's model. A balance above $15,000 against that same income profile elevates the flag probability significantly. A balance above $25,000 in a checking account against a standard retirement income profile in 2026 places you in the highest risk category for a balance-to-income mismatch flag. Write those numbers down. $8,000 to $10,000, elevated attention zone $15,000, significantly elevated flag probability $25,000 and above, highest risk category. This is the number the banks will never post on their website. The number no financial advisor on television will name because their advertisers are the same banks that profit from keeping your deposits exactly where they are. Your checking account was never designed to hold your savings. It was designed to be a transit station. Money arrives, passes through, and moves on to a safer destination. Here is exactly what to do. And I want you to picture each step happening at a specific moment this week, not as a list on a piece of paper, but as real actions at real times. Tonight, after dinner, sit down at your kitchen table. Open the last 6 months of your checking account activity. Look for any deposit that stands out as significantly larger than your normal monthly pattern. The inheritance, the settlement check, the car sale, the retroactive government payment. Find the paperwork that documents where that money came from. Put it in a single folder, somewhere easy to reach, because if your bank ever asks, you want to be able to answer within 24 hours, not 24 days. Tomorrow morning, if you received any retroactive Social Security payment related to the Fairness Act in 2025, call your tax preparer and ask one direct question. Did this deposit require any additional disclosure on my tax return? That one question can prevent an income discrepancy flag from firing months from now when you least expect it. This weekend, open a high-yield savings account or money market account at a different institution from your checking bank. Not a different branch, a different institution entirely. Move your long-term savings there. If your checking account is ever flagged and placed on hold, your savings at a separate institution remain fully accessible. You can still buy groceries, fill prescriptions, pay utilities. The disruption stays contained. The next time you need to make a large cash withdrawal, do it in one single transaction. If you need $9,000 in cash for any legitimate purpose, withdraw $9,000 at one time on one day. Never spread a large withdrawal across 3 or 4 days to stay below $10,000. A single transparent $9,000 withdrawal is legal and raises no flag. Three $3,000 withdrawals across a week is a structured pattern that the algorithm treats as a federal felony, regardless of your intent. Transparency protects you. Splitting destroys you. The next time you meet with your tax preparer, bring a list of every person you pay regularly in cash for services at your home. The lawn care person, the housekeeper, the caregiver. If you have paid any single person more than $600 in a calendar year, you may be legally required to file a 1099 form for that person. Your tax preparer can handle this in minutes. Ignoring it creates a paper trail inconsistency the monitoring system can flag. Before I let you go, I need to give you one warning that has nothing to do with the IRS monitoring system and everything to do with criminals who are exploiting the exact fear this topic creates. Right now, this week, scammers are calling seniors across this country claiming to be IRS agents, claiming that your account has been flagged, demanding immediate payment to resolve the issue, threatening arrest if you hang up. Every single one of those calls is a criminal scam. The real IRS does not call you without first sending written notice. The real IRS does not demand immediate payment over the phone. The real IRS does not threaten arrest during a first contact. The real IRS does not ask for payment in gift cards, wire transfers, or cryptocurrency. Every single legitimate IRS communication arrives in your physical mailbox on paper with a notice number printed on it that you can verify independently at irs.gov. If your phone rings and a voice claims to be calling from the IRS about your bank account, hang up without saying another word. Then call your bank directly using the number printed on the back of your debit card to confirm your account status yourself. I want to bring you back to Margaret Chen one final time. Margaret got her money back after 11 days. Her property tax was paid late and she owed a small penalty to the county. Her account hold was eventually lifted after her bank reviewed the documentation she provided, showing that her $31,000 balance came from 3 years of careful saving from her monthly Social Security and pension payments. The system had flagged her for doing exactly what every financial advisor in America tells retirees to do: save carefully, be patient, build a cushion. And that cushion, sitting quietly in her checking account where she had always kept it, is what put her in the system's crosshairs. Margaret's story is not unique. It is not rare. It is happening in Phoenix and Tampa and Cleveland and Spokane and every city and town in this country where retirees are doing everything right and still finding themselves on the wrong side of an algorithm that does not know or care about 43 years of responsible banking. What you do with the information in this video this week determines which side of that line you stand on. Move your savings out of your checking account to a separate institution. Document your large deposits. Ask your tax preparer the right questions. Make your large cash transactions transparent and singular. Do those 4 things this week and you have done more to protect your financial security than most Americans will do in the next 5 years. If this video gave you information that your bank and your financial advisor should have given you years ago, please share it with one person you care about today, especially someone over 65 who keeps their entire savings in a single checking account and has never once been warned about what that balance might be quietly triggering. One share, one conversation, one phone call to a parent or a neighbor or the friend from church. It could save them from a Tuesday morning they will never forget. And before you close this tab, the very next video on this channel answers the question that every single person watching this right now needs to know the answer to before they do anything else. What do you do the moment your account is frozen? Not after you have waited 3 days and the hold is still there. Not after you have already missed a bill. The exact moment you discover the hold exists. The precise words to say to your bank teller. The exact person to ask to speak with. The specific documentation to bring with you. And the one phrase that compliance officers respond to immediately that most account holders never know to say. That complete word-for-word guide is the next video. Do not wait until you need it to watch it.